Learners, you have reached this particular chapter number 9 of our course of Basics of Economics. And this particular chapter is basically a very, very important chapter in this entire study of economics, because from 1991, when the economic policy was implemented, there was a complete turnaround that happened in the Indian economy. Now, in this case, when we are talking about the year 1991, it was a very crucial time frame. So, this particular year, 1991, what happened in India was that the foreign reserves dipped to a very low extent. And for the purpose of keeping the country going, that means for buying the goods, that is, importing the goods, the reserves were insufficient. That means not even a week supply of foreign reserves were left in hand. And if at all there would be, if it would have continued in the same manner, then the country would have collapsed into a huge national crisis. So, for that purpose, there was a sudden change that took place in the year 1991 to overcome this particular hurdle, this problem that was happening in India. And this is what we study as what is called as the economic policy in the year 1991. What were the main objectives, let's see, of this particular economic policy? The first main objective was to actually take the Indian economy into the arena, into the viewpoint of globalization. That means globalization would be introduced in the Indian economy. Then basically we had rising prices of different commodities in India. So to curb that, to bring down the inflation, to bring down the prices, there was a necessity of this policy. Then there was a disequilibrium between the balance of payments. Now, what is this balance of payments? That means we are talking of how much we have in terms of the foreign currency earned in terms of in terms of exports, and how much is the amount that we need to pay in terms of imports, right? So when you're buying goods, you pay, and when you're selling the goods, you are actually receiving the money. This happens even in case of foreign trade, and this, when netted off, becomes the balance of payments. And this, there was it was like quite less. We had less amount of foreign reserves, and there was disequilibrium between how much we have to pay and how much we are going to get, and the amount that we were going to supposed to get was very low. And to bring up these reserves, or to bring up the foreign currency that was available in India, this particular policy was implemented. Then, to achieve the economic stability and to curb the fiscal deficit. So, as we have seen, the balance of payments position was bad. There was deficit in terms of foreign reserves, and so this policy had to be brought to reduce on this problem. Then, if you see, till the year 1991, India was mainly focused on its own industrialization, on terms of more of public sectors, more of socialist type of economy, which was more, you can say, in terms of self-sufficiency. We did not rely much on exports, nor did we want any imports to happen. So it was more like a self-reliant economic structure which was tried by the government to be made, but somehow it did not succeed much by the year 1991. And so it was necessary to bring up the other industries from other countries so that India could make a progress. And finally, to help the private sector to participate in the overall industrialization. So this is what was the necessity. This is what you can say are the main objectives of this 1991 economic policy. Okay, so this is the first part. Now, second part, what we are going to see is what were the features of this economic policy of 1991. Now, first important thing that they did was delicensing. Now, what is the term licensing? First of all, licensing means a government authority or some authority which is appointed by the government gives a certificate, gives a license, gives, you can say, a permission to do a particular thing. Like suppose we are talking about food license. So if you want to start a restaurant, if you want to start a food facility center, or you're selling food products, then what is issued from the government side is called as a food license. So it's a permit, it's a permission which is given by the government to allow you to supply the food. So delicensing was specific in terms of not having the requirement of government authorities to give you licenses. So it's not in all cases that you don't require licenses. There are certain licenses which are required even today, but somehow a lot of licenses which were unnecessarily required in the earlier time frames were abolished. So what they did was, instead of bringing everyone into the license system, what they did, they said, okay, these 18 industries which are listed out here, you can see the list of like electronics, aerospace, defense equipment, industrial explosive, hazardous chemicals, drugs and pharma, cigarettes and such other type of commodities which were listed out by the government. Only those commodities would be required to take a license. Okay, so except for these 18 specified industries, no other industries would require the license from the government. That is what we mean by delicensing, which is the first feature of this economic policy. Now let's go to the second feature. What was the second feature of this particular policy? Abolition of monopolies and restrictive trade practices. Now, a very important part, till 91, you would see only one player in the market. One player meaning only one person or one company which was operating in a particular sector. Let's say, for example, if you're talking of steel manufacturing, only one company would be allowed to make and sell the steel products. But what about the competition which brings down prices? What about the benefit of getting better quality because of competition and so on? So this was not existing, right? And so there were a lot of monopolies and there were a lot of restrictive trade practices by the government, which means you are not allowed to conduct trade, you are not allowed to conduct business of certain goods, certain products. So what happened after 91? What was the change now? The change was that there was a focus on removing these kind of monopolies and restrictive trade practices, so allowing new players to enter that market. Like suppose if you say telecom, there could be two or three or four players in the market, which means because of competition, they have better competitive prices. These monopolies and restrictive trade practices had a very bad impact because there was a compulsive requirement on for the large industries and other such industries to take the permission of the central government for their expansion, mergers, and even establishment. So, obviously, if you want to tie up with someone and have an expansion, you would need permission. Without permission, you can't do it, right? So, restrictions were there. Then the government used to say that okay, only one person will be there who does this in or who sells this product in the market. Now, what happens if this monopoly type of thing exists? Then it results in slow industrial growth, because obviously if you don't have competition, you're the only person who's selling the goods, you don't worry, right, of profits of any kind of such things. Then with this abolition, which with the MRTP Act, that is the Monopolies and Restrictive Trade Practices Act, this act was abolished, and because of this there was a lot of growth, new players came in, and because of it industrial growth happened. Next important change or next important factor, as we can call, of this particular economic policy of 91 was that it encouraged small industries. Very important, because in India, if you see, entrepreneurs, small traders, small businessmen are very important for the growth of our country. If these people are discouraged, are not put into business, then the country cannot progress. So after 1991, every small player, entrepreneurs could get they got a lot of encouragement, because new avenues were opened up, then new collaborations could happen, and so it was a lot of benefits were passed on to these small entrepreneurs. Now, what was the investment limit? Investment limit was increased from 1 crores to 5 crores. So when we say it's a small industry, 1 crore now it will be 5 crores. So up to 5 crores it will be considered as a small industry. So many people could be classified under that and they could get encouragement. Next is what we have as encouragement to foreign investment, right? Industrial policy of 1991 approved foreign direct investment. Earlier, India had a lot of restrictions on foreign investment. The reason because the government felt that if foreign players come into the market, they might just take over the market, dominate the market, and somehow our own industries will suffer, which they didn't want. So, Swadeshi, or you could say make in India, made in India, as we have right now, was something which was already happening before 1991. But later they realized that with this, what is happening, we are not having the required growth pace which is required in our economy. And so, opening up in the year 1991 led to foreign direct investment, foreign players putting in money into the Indian market. So, what is foreign direct investment? It is foreign players directly investing in the Indian market. So this is necessary. Why is it necessary specifically in initial stages? Because there are some high priority sectors which require a huge investment, which Indian players or Indian industrialists were unable to offer. So they require help from outside. Clubbed together, they could actually make more business, have more investment, and give more employment. Initially, what happened to keep their hold? India did not permit foreign direct investment of more than 49%. Then what it did, it said, okay, fine, no problem. Control can go in the foreign hand. So 51% stake was allowed. Then in some sectors, even 74% stake was allowed. And now in many sectors, we find foreign direct investment can happen up to 100%. So you don't need an Indian person to actually collaborate with the foreign industry if foreign direct investment is allowed up to 100%. If suppose foreign direct investment is allowed up to 51%, means foreign company has majority stake in the company, but at the same time you need 49% of shares of the company's ownership from the domestic Indian person, right? So that's important to not lose the entire control to a foreign player. So any industry which is of key significance should be considered at a lower foreign direct investment. Like suppose if we say defense should be kept at a lower non-controlling stake in the hands of foreign players. Next in line, if we have to speak about the features of this particular policy of 1991, the fifth feature says reducing the role of public sector. Important. Private sector is equally important. And if we see today, right from 91 till date of 2025, if we see the progress that has happened in India, it is very, very specific to the private sector. So private sector, it has entered in different fields and these fields have grown. Like suppose if we take example of information technology, IT industries, even healthcare for that matter. So drastic change has happened in the facilities, in the provisions, in the services offered, in the type of products offered in these avenues where private sector has entered. So quality, the quantity, the profitability, everything increases as soon as you introduce the private players. Even consumers get the benefit. Why? Because on large scale, if it is being manufactured, the prices drop. Similarly, there will be competition because not just one player is allowed. So two or three players are taking into consideration these kind of industries, and so prices will drop for the customers automatically because of competition. The changes which were made in the public sector policy were related to ending monopolies, as we have seen earlier, improvement of public sector, the efficiency at which it performs, then releasing the capital blocked in sick public sector enterprises. Now what happened during this phase of 1991? Many public sector companies did not have the required, it was not the profits. they didn't have the profits, capital was blocked, and they were declared as what we call as sick industries. Sick industries means they are not in the state of profitability, not in the state of quick revival. That means it's not just a short term drop in the profits, but a long term sequential drop in profits, and also there could be losses. Or at the same time, these industries did not have much business, because of which they were called as sick industries. So these sick industries were actually in the public sector, and so what happened, instead of continuing them, they released that capital there and put into some other industries, or some private sector industries took over these public sector sick units and used whatever their establishment, land, building, machineries were available and started off their business. So it became easy for them also as a launch. Okay. Now, in the year 2014, a big major change was made where the public sector remaining industries were only in the defense and railways. So rest everything was somehow partly, fully privatized. Then the sixth feature of the economic policy is connected to trade liberalization. We have seen this in different portions of other features also, but a quick glance we can take on this trade liberalization is basically connected to abolishing of many licenses. So controlled uh, part of the government was reduced or somehow abolished in many sectors. Then most goods like capital goods, raw materials, intermediate were made freely importable. Now, what happens when you start an industry in India and you need some imported product from another country, let's say Japan? But your trade does not allow buying products from outside. Will this work, this kind of sequence? No. It will be a big hurdle, right? So, to disallow that problem or just do away with that problem, what the government did was it said there will be many products which will be freely importable. So, if you need these products, you can buy it from outside the country, just pay whatever the duties are related to that product and bring it here. Then there was another feature in trade liberalization which was connected to getting funds from outside. So even external commercial borrowings for that matter. So if you need funds from, let's say, another country like maybe a European country, France, let's say, you can take it. If you need borrowings from Japan, you can take it. So if they are giving you a loan, right? External loans are there, you can take the loan. So credit facilities were actually made available so that these people benefit. So industries and other people benefit. Then we have seen SEZs and agro export zones. So SEZs were like the special economic zones. AEZs were the agro export zones. So these were made available by the government for the industries which were interested in having a platform, having a setup in that location. So once you locate in these regions like SEZ or AEZ, you have a lot of benefits from the government's end, including tax benefits, income tax benefits, indirect tax benefits, customs duty benefits, then availability of resources like electricity or other such resources at cheaper rates, and so on. Seventh one, which connects to the insurance sector, this particular feature is very important because earlier only public sector was into insurance industries, but later after this policy came up, insurance sector was also open to private players. So a broadened avenue for insurance covers was there. So for vehicle insurance, health insurance, life insurance, many private players, like today also we have a list of different private players which are functional in India in terms of, you can say, the insurance industry. So with this, people also started getting the benefits of insurance cover and could protect their interests. Then IRDA, which was the Insurance Regulatory and Development Authority, was set up in 1999 and it introduced a number of reforms to this sector. Then there were reforms in the financial sector. So earlier we found that cooperative banks, public sector banks were permitted to do banking business. New economic policy said even private banks can come into force and they can take the necessary permissions from RBI, from other government officials, and then set up the bank. So there were like scheduled banks were started, even foreign banks were allowed to come to India, and so on. So, learners, in this first part, we learned about the economic policy of 1991 and its features. In the next part, we are going to understand what are the components of this particular economic policy in detail. So, let's proceed to part 2 of this chapter.